In this video, we'll introduce the concept of valuation in biotech. We'll discuss why valuation matters and then give a brief overview of different valuation techniques. So this will set the stage for subsequent videos where we'll talk about more specifics around DCF and Compsbased valuation techniques. So in previous videos, we talked about value, which is the value of a company is the present value of the cash it generates in the future. And valuation is just a way of estimating what the present value of those future cash flows are, right? Because these happen in the future. You can't know what they are. You can only do your best to estimate them. And that's what valuation is in large part about. So we're going to start off with an example here of a hypothetical company aptly named Hypothetical Therapeutics. And this is going to help illustrate why valuation matters and how you can use it in biotech to make better investments. So this is a hypothetical oncology company. Their lead asset is in a phase 2 study. Their market cap is 100 million, 70 million in cash, no debt. And they recently traded down 80% from a prior market cap of 500 million because a competitor targeting the same pathway as Hypothetical Therapeutics had an unacceptable safety signal in their phase 2. The drug seemed to be effective in reducing tumor volume, but there were unacceptable side effects. So competitor stock traded down, and because Hypothetical Therapeutics targets the same pathway, their stock traded down as well. So this is something that you'll see fairly often in biotech. So in previous videos, we talked about how a stock might move due to the company releasing clinical data. But a lot of times, if there's clinical data that comes out for another drug that's in a similar class or targets the same target or has a similar mechanism of action, you will often see read-through from one company's data to another's data in stock price as well, because they have similar products from a scientific or clinical perspective. So we'll quickly walk through this super high level, hypothetical mechanism of action here, so we can better understand how scientific insight, why scientific insight matters, and how you can use valuation to support your scientific insight in your decision making around investing. So this competitor drug inhibits the target, and then that leads to tumor shrinkage, which is good. But there are also safety issues, which are not so good. However, you happen to do research in your PhD study, research of this pathway, and you happen to know a little bit more than the market does about how this particular protein functions. And specifically, you know that there are two main downstream proteins that mediate the effects of this target protein. So there's downstream protein 1 that is increased by this protein, and then higher levels of this protein lead to tumor growth. And then we have downstream protein 2, which is involved in healthy function, and levels of this protein are also increased by the target protein. So the competitor drug inhibits the target here, which reduces downstream levels of both of these proteins. In this case of downstream protein 1, reducing levels is good because that shrinks tumor. But in the case of downstream protein 2, it's not good to reduce the levels of this protein because it's needed for healthy function, so it causes safety issues. So if you pause here and think about this from sort of a drug design perspective, you might think that, well, why don't you just target downstream protein 1? That way you would get the positive effects of tumor shrinkage and you wouldn't mess with this pathway that's important for normal healthy function. And that's in fact what Hypothetical Therapeutics is doing. So they've designed an inhibitor of specifically downstream protein 1 that leads to tumor shrinkage and doesn't mess with the healthy function that downstream protein 2 is involved in. Okay, so with that, very high level fact pattern in mind, in the valuation information and information on the trading history of the company, do you invest? So just to recap, this company, Hypothetical Therapeutics, traded down 80% because a competitor study failed. The competitor study failed because despite their drug being effective at shrinking the tumor, it had unacceptable side effects. You have done a lot of research in the space studying the pathway that both of these companies target, and you have a really strong conviction that the mechanism of action of Hypothetical Therapeutics product will avoid the safety issues that the competitors saw. So do you invest? So it's not a trick question here, but we'll just kind of go through a simple quantitative example of how you can think about this investment decision in a little bit more quantitative manner. So the current market cap is $100 million. And we're assuming this is a single asset company, and this phase 2 study is sort of the biggest driver of the company's valuation. So essentially, you can decompose the market cap into the probability of success of the study times the market cap if the study succeeds, plus 1 minus the probability of success of the study times the market cap if the study fails. And here we assume that 500 million is the market cap if the study succeeds, because that's where the stock was trading prior to the competitor's negative data readout. In reality, the stock would probably trade higher than 500 million if the study was successful, just because that $500 million valuation probably baked in some probability of failure for the phase 2 study. And once the phase 2 study is actually successful, then that probability of failure will no longer exist. So the valuation will be higher. We've used 50 million here as the market cap if the study fails. They have like 70 million in cash. So we just assume that they traded a slight discount to cash if this study fails and it's their only asset. So we can quickly solve for a probability of success. And it's like 11% in this example. But again, because the $500 million, you can almost think of that as a floor for the company's valuation if the phase 2 study is positive. In reality, the market's ascribing probably a less than 10% probability of success to this study. So if you think that the probability of success is dramatically higher than 10%, then this might be a good investment. But what if you think the probability of investment is like 15% or 20%? Can you invest around that, or does it need to be, do you need to think it's like a 50% or a higher probability of success to invest? So that's sort of where valuation comes in. Another way to think about that is, maybe you invest if the market cap is 100 million, but what if the market cap is 200 million? What if it's 500 million? What if it's a billion? As the market cap at which you invest increases, the probability of success in the market is pricing in also increases. So if you think the study is going to succeed, you don't really have as much of a divergent view if the market also thinks that the study is going to succeed. So obviously, if you think about it, the investing decision should become more difficult as the market cap of the company gets higher. So one thing this valuation can help you do, and this is how I like to think about valuation, especially from a clinical or earlier stage biotech perspective, is valuation helps you understand the terms and the odds of the bet that you are making. So when I say the terms of the bet, I mean, which assumptions are you betting on? Which assumptions is the market betting on? So in hypothetical therapeutics example, the probability of success of that phase 2 study is really the core assumption that drives the stock price in the near term. The stock might also move based on information around, the ultimate market size or some other competitor drug that's earlier stage or various other things like that. But all of those assumptions don't have as much impact on the near-term valuation as this probability of success for the phase 2 study. And when you do a valuation analysis, you will get a better insight into which assumptions drive the stock in the near term. And you should supplement this by talking to other investors and sort of getting a sense for what consensus is. But valuation is a good way to ensure rigor and discipline around that exercise. So in addition to getting you the terms of the bet, valuation can help you understand the odds of the bet. How much you might make if you're right, and how much you might lose if you're wrong. So in our example of hypothetical therapeutics, at $100 million valuation, if the phase 2 study succeeds, the stock's going to go up at least 5x, you think. And then if the study fails, the stock will go down probably at most 50%. So your upside is much higher than your downside in that case. And that's an important thing to take into account when you're making an investment decision, right? If the market cap is 500 million and you think that it's going to trade up to 600 million if it's successful, but if the study fails, you think it's going to trade back down to 50 million, then your upside is much lower and your downside is much higher, and the odds of that bet are not as favorable to you if you're an investor, if you're a buyer of that stock. However, the terms and the odds of the bet are not the sole inputs into the investment decision, obviously. Your risk tolerance, target return, and conviction in your thesis will determine what odds you accept. So if you have a certain financial goal that requires you to get at least a 10% return on each investment you make, then obviously you're going to need that level of return for each investment in order for it to make sense for you and your personal goals. Likewise, your conviction and your thesis is very, very important. So in the hypothetical therapeutics example, if you have a ton of conviction that hypothetical therapeutics mechanisms of action will avoid the safety effects the competitors saw, then you can invest at a much higher valuation. So for sort of a way to put this in terms of the formula we laid out, if you have a high degree of confidence that the probability of success at that phase 2 study is like 60% and the market's pricing at under 10%, then that's an investment that you should make as long as your target return is under under 5x. However, if you don't have a ton of conviction in their thesis, if you think, yeah, this might actually work, but you're not totally sure, then maybe you invest at 100 million, but maybe at 200 million, 300, 400 million, maybe that's a little bit too tight for you. Maybe that doesn't provide you enough margin of safety given your conviction, and maybe you don't invest at that level. And then obviously risk tolerance is a huge factor as well. The higher your risk tolerance, the more investments are acceptable to you, because you don't really care as much about if you lose money. So another thing that I'll mention here about valuation is when you read about valuation or hear people talk about valuation, a lot of times you hear them say it helps you determine the intrinsic value or the fair value of a company. And that's partially true, but that can be a little bit of a siren song when you talk about early stage biotech valuation, because any valuation technique you perform, even like the best, most rigorous DCF for an early stage or a clinical stage biotech company, is going to be so uncertain. There are so many assumptions that go into that model, and each of those assumptions has a huge impact on the overall stock price. So if you're a little bit wrong on a key assumption, your valuation is going to be completely incorrect. So yes, you can think about valuation from the perspective of an investor in early stage biotech companies. You can think about valuation as a way to sort of get at the fair value of a product, but with the huge caveat that you need to be very, very careful about how much confidence you have in that valuation. These are imprecise and inaccurate valuations. So just be very mindful of that. This is an art, it's not a science. So how do you actually implement that caution? How do you actually act on that advice of be careful about relying too much on evaluation? It is quickly, don't use a valuation analysis as a big as a reason to invest. Right? Just saying a company is undervalued is not a reason to invest in biotech. You need to start with a differentiated view on the science or the market opportunity or even something like the management team. And then you do your valuation analysis to tell you, okay, this different view that I have on something about the company, does the market care about that? Does that move the stock price? So that's the first thing. That's the terms of the bet we talked about. And secondly, think about, if you're right about this divergent view, if you think something that the market doesn't think and you're right, how much do you make if you're right? And then how much do you lose if you're wrong? So what are the odds of the bet? Okay. So when I talk about valuation in biotech, a lot of what I'm talking about is really just understanding the terms and the odds of the bet. You can get a rough sense of a company's value as well, but just be mindful that it's a very rough sense of the valuation. Now, if you are in a different field, if you're not an investor, if you're like an accountant, for example, and you're doing a valuation for like 409A purposes, then you're going to look at valuation from a different perspective. You don't care about the odds in terms of the bet. You want to find a specific value that's defensible that you can use for your work. Likewise, even if you're a financial analyst at a big pharma company and you're working with a huge team of people to value a potential acquisition target, for example, then the goal of your valuation is different. Your role as an analyst doing the valuation is different. So you're going to approach valuation in a different way and use different techniques. So a lot of the stuff that I talk about here in these videos is specific to investing and specific to investing in early stage biotech. And basically the most important takeaway here is the strength of your assumptions is much more important than the robustness of your valuation models here, which is why it's so important to have scientists and medical doctors in biotech investment, because everything is really driven by this differentiated view on the science, the clinical profile, or the market opportunity. The valuation analysis is supplementary, not primary. All right, so with that out of the way, this is a quick overview of common valuation techniques. So we'll go through each of these in more detail in subsequent videos, but this is just an overview of some common ways to value companies in general, and then the ones in bold are commonly used in biotech. So there's two basic buckets of valuation techniques that are used. So one is fundamental valuation methodologies, of which discounted cash flow analysis is very prominent. And when I say fundamental, I mean you're trying to get at the future cash flows that a company will generate and then determine the value of the company that way. The second bucket are multiples-based valuation or comps. So these are more like market-based as opposed to fundamental-based valuation metrics. And when I say market-based, I mean you're thinking about the value of a company in terms of what others are willing to pay for that company. You still think about some of the fundamental drivers of value, but there's a much bigger input. The market valuation and the price investors are willing to pay is a much bigger input. So I'll quickly walk through these here, and then we'll go on another slide to touch them in more detail, and then subsequent videos we'll go through even more. But the DCF, you're basically building a model here to project the cash flows every year in the future up to a certain time period, and then discount those cash flows back to a present value. So we'll talk more about what discount rate and discounting means, but just for now, just know that it represents what's called the time value of money, which means $1 today is worth more than $1 tomorrow, because you can invest that dollar and you can generate a return if you invest it today. So that dollar today invested at, say, a 5% interest rate will be worth, $1.05 in a year. So $1 today is worth more than $1 tomorrow. And then the discount rate is different depending on the company, but in general, you can think about it as the opportunity cost of an investment. So if you have $100 to invest and you have 6 things that you can invest in, you have to think about not just the return from an individual investment, but what return would you get if you invested in something else, right? So if investment A gives you a 10% return, but you think investment B is going to give you a 15% return, then you should probably invest in investment B. But you would need to discount investment B by 10%, which is the discount rate that you would use, because that's what you can get from investing in other products. So don't worry about that if it doesn't make too much sense now. Just for now, know that the DCF, you project the cash flows that a company will generate in future years, and then you just discount them back because money tomorrow is worth less than money today. So the next bucket are comps-based valuation techniques. So these comps-based valuation techniques basically abstract a lot of the assumptions away from a DCF. So when you build a DCF, you have a lot of specific assumptions that you're forecasting around the number of patients who get a drug, what the price is going to be, what revenue is, how revenue grows every year, a bunch of assumptions around the different costs of the business. There's a lot of complexity that goes into building a DCF. Comps-based valuation, you abstract a lot of the assumptions away. You say, we don't care about a lot of these assumptions. In most cases, we're going to have similar assumptions for like COGS for, company A and company B. So we can abstract a lot of that away and then just have a constant called the multiple that represents all of these assumptions at a DCF. And then you use one specific financial metric as your variable of interest. So basically, to do a comps-based valuation, you pick a set of similar companies called comps. So for a phase 2 oncology company like Hypothetical Therapeutics, you'd probably get a group of other, oncology, small molecule therapeutics and mid-stage clinical studies. And then for each comp, you calculate the relevant metric. So earlier we have here different metrics. So all of these are ratios that you use to calculate a multiples for comps. So these are all different ways to abstract away different assumptions around a company's financial performance and sort of normalize it with a certain financial metric. So they're all of the format. The numerator is some equity value or enterprise value, some way to measure the value of a company. And then the denominator is a specific financial metric, usually related to earnings or profit or to revenue. So here, PE, you're looking at market cap or equity value over net income, which is a profit metric. EV to EBITDA is another common ratio, not as much used in early stage biotech, but here you're looking at enterprise value and you're dividing it by EBITDA, which is another sort of earnings metric. You also look at enterprise value divided by revenue, enterprise value divided by peak sales, which is basically revenue, but when you do a revenue multiple like this, you're either doing it on last year's revenue or next year's revenue or revenue in 3 years. But in peak sales, you don't care about a specific year. You just want to get the year, the level of peak sales. And then discount to M&A value is a little bit different. We'll talk about that later. But all of these comps serve the format. The numerator is equity value or enterprise value, and the denominator is a revenue or a profit metric. So then once you have your comp set and you have your target metric that you're looking to calculate, just do that simple math for each company in the comp set, and then that will get you a valuation range for your target company. So if your comp set, for example, if you're looking at EV to peak sales, and you have 10 companies, you calculate EV to peak sales for each of those companies, the average multiple is, let's say, 5x, then you might just multiply the peak sales of your target company by 5, and that will get you your enterprise value. Sometimes you'll use the median value. Sometimes you'll have a wider range of the values you use from the comp set. But that's the basic principle behind it. So we'll talk about this in a different video, but just to sort of start you thinking about the logic behind these comp sets and how you could use them in practice. So why might one company have a higher revenue multiple than another similar company? So if they're both targeting the same indication and it's a somewhat similar mechanism of action, maybe a little bit different, maybe it's going after a different target, but the same patient population, why might one company have a higher revenue multiple than another company? And another question to think about is, why would you use a revenue multiple in early stage biotech as opposed to an earnings multiple, which is commonly used for other industries? Additionally, why would we use peak revenue as opposed to using next year's revenue or last year's revenue or revenue in 3 years? So just things to think about to understand sort of the logic behind valuation. We'll talk about those more later. And this is just a quick chart that sort of lays out these different valuation techniques used for early stage biotech on a couple axes. So this y-axis, just the time it takes to do the analysis. So discount to M&A is basically a valuation technique where you say, for this particular type of company, it's often acquired by a larger pharma company at some point. So to value that company, you're sort of arbitraging, sort of like an M&A sort of arbitrage. You think that a company might be acquired, so you value it based on some discount to the price at which an acquirer might pay for it. So you just pick a group of companies that are similar and that have been acquired, see the valuation that they had, and then you just say, maybe, we think there's a 25% chance that this company will be acquired at a level similar to what the comps were acquired at, and then you do your valuation that way. Very quick and dirty. On the other hand, you have a DCF where you have to literally forecast and do research on dozens of assumptions, and then the actual calculation is a little bit more complex as well. So that takes a lot more time. And then a peak sales multiple is somewhere in between. Finding the peak sales of a bunch of different companies is a little bit more time intensive than finding the M&A comps, but it's still a pretty straightforward exercise to do this. And then we talked a little bit about market-based versus fundamental earlier. So the DCF is more fundamental. It still does take input from the market, but you're really more focused explicitly on understanding the fundamental underlying assumptions that drive the future cash for the business. Whereas something like a discount to M&A, you really just care about what others are paying for these assets. And you only care about the fundamentals in as much as they are incorporated in the valuation that other companies pay, or, with respect to the specific odds used to handicap the likelihood a particular company will be acquired. And then peak sales multiple is somewhere in between. You are taking a lot of input from the market, but then when you choose your multiple, you are thinking about specific fundamental considerations of a company. And as you do more DCFs and get more familiar with what moves stock prices and which assumptions you use and how companies stack up on financial metrics, then you can start being more comfortable using comps, because at the end of the day, again, comps just abstract away a lot of the complexity of a DCF. And if you have a good sense for what moves the stock price, then you can be a little bit more intuitive about using comps. But for most, or pretty much all valuations, you're going to use a variety of techniques to arrive at the valuation that you ultimately use to inform your investment decision. So that's it for this video. Next video, we'll talk about discounted cash flow analysis specifically. There's a spreadsheet that I've put together, a Google Sheet I've put together that walks through an example DCF and tells you sort of what each line item represents, where you can find the information to support each assumption, and that will be shared in the next video as well. So thanks for watching. Hope you guys enjoyed this. And again, if you have questions, comments, feedback, let me know in the comments. Thanks.